Surprise tax bills. Nobody likes having a surprise tax bill. So this video is all about making sure that you don't get a surprise tax bill. It's part of a series of videos about tax and accounting issues. So if you'd like to hear and see more content like this, then please subscribe to the channel, and it really helps me if you press the like button. Surprise tax bills. I think the biggest area where people have surprise tax bills is with self-assessment. And the reason that people have problems with self-assessment is because the tax rates are high and because of the peculiar way in which the system works. So let's just think about the rates. So the basic rate of tax is 20%. So after your personal allowance, you pay 20% tax and 40% as a high rate taxpayer. So 20% for everybody. Then on top of that, if you've got student loans, you've got 9% student loans. And on top of that, if you're self-employed, then you also get 9% national insurance. So as a basic rate taxpayer, you're paying 20% plus 9% plus another 9%, so 38% in total. And as a high rate taxpayer, much more than that. So there's a high rate of tax on substantial amounts of income very often. So you end up with this being your main tax bill, and therefore this is where surprises are most likely to happen. But they happen also because of the peculiar way in which the tax system works. So if I was to start a trade in April 2020, then I start in April 2020, I go on to April 2021, I don't pay any tax during that year. And I don't pay any tax until January 2022 when I do my tax return. So we start in January 20, we start in April 2020, and we go all the way through to January 2022, and we've paid no tax. So we've got used to not paying tax, and in January 2022, we pay 18 months worth of tax. So it's like a double hit. We're not used to paying tax, and then we pay a whole load, and then we go on to a system of paying tax in January and July. And it should also be noted that if your income increases substantially from one year to the next, you also get hit by this 18-month tax rule the following January. So it's something that just pokes people from now and again, and it's something to keep remembering if your income is increasing or fluctuating. So that's self-assessment, and I want to go through the ways of making sure that your self-assessment is okay later on in the video. I think there's some other important sort of health checks that I want to do. First is capital elements of a loan. So capital elements of a loan, what I mean is, so if you own a property and you rent it out, the rental income is taxable, and then you're paying a mortgage. Now if it's a repayment mortgage, only the interest element is tax liable, and interest is so low at the moment, it's a very small part of it. So what you can end up with is receiving income, paying all of that out in mortgage repayments. So in cash flow, you're sort of breaking even, but you're not in terms of the tax man, because the income is tax allowable and most of the expense or the cash going out is not tax allowable. So even though you haven't got a cash profit, you are going to pay tax on it. So that catches the odd person out, not surprisingly, because it's a bit odd the way it works. No personal allowance when you've earned over £100,000. So the first time you earn over £100,000 a year, if you're lucky enough to earn over £100,000, it can often catch people out because the revenue isn't very good at doing pay as you earn on it. So it's worth remembering that if you are earning over £100,000, then you won't get your full personal allowance, because it is reduced between £100,000 and £125,000 a year. And just making sure that you're getting your tax saving for that eventuality can help make sure that you don't get a surprise tax bill. Buy to let, so declaring your buy to let. So we get a trickle of people where the revenue found that they haven't declared their buy to let, and although the tax on one buy to let property isn't huge in a year, it's tax to pay, so we don't enjoy it, but it's not huge. But if you've got 6 years to go back and you've got interest and you've got penalties, then that can add up to a substantial amount. VAT, so particularly for the self-employed and tradesmen, it's really easy to go over the £85,000 limit for VAT and do it without really knowing, because prices of things are just drifting up and the limit for VAT has stayed the same. So there's a conflict there, and more people are going over the limit. And if you're not organised enough, then if you bring your books in and we do the accounts, say 6-9 months after your year end, then you could be a year or more over the VAT threshold without knowing it. And you should have been charging your customers VAT all this time, or you should have been making sure that your revenue is less than 85,000. And that is going to be a really big tax bill, because VAT is a tax on your sales, less any expenses that have VAT on them. But it's a big tax, and it can really catch people out. So making sure that you understand the £85,000 VAT limit is an important way to avoid having surprise tax bills. I want to look at directors' loan accounts. Directors' loan accounts are peculiar things because it's where you lend money to your company. So this is for people with their own limited companies. And very often you put money into the company when it starts up to provide its initial capital, and then you draw that down over the years. Now there's a couple of things that can happen. One of which is you can be drawing money down for a number of years, and then suddenly you've used it all up and you have to pay tax on the money that you're taking out of the business. And that, if you're not used to it and you're not expecting it, that can create a surprise tax bill, particularly if you don't really understand and haven't really paid attention to your director's loan account. And the other side of it is that if you overdraw your director's loan account, so if it ends up that you owe the company money because you've taken out money that you haven't received in dividends, then there is a tax implication of that. And there's a 32.5% tax in the company if you've got an overdrawn director's loan account that you can't repay. And that can catch a few people out, particularly because it's a tax that happens when you're not doing very well, because the reason that you've overdrawn your director's loan account, you've taken out money that you shouldn't really have taken out, is because the company isn't doing great, and in order for your personal finances to work, you've taken money out of the company that's normally it should be in your tax savings account. The underlying reason is that the company isn't making as much profit as you need to live on. So so making sure that you've got your tax money saved in the company, that you don't go overdrawn on your director's loan account, and you understand the position of your director's loan account, is an important way of making sure that you don't get surprise tax bills. Earning more than £4,000 a year. So if you earn more than earning more than £4,000 a month. If you earn more than £4,000 a month, then you're likely to be a higher rate taxpayer. And the tax almost doubles when you become a higher rate taxpayer, and people don't like it. But it's very easy to fall into that trap. So if over the years your profits are improving and you're doing well, then there comes a time when you take out more because the money's in the company, you can spend it, you can take it out. But if you're not careful, you'll be taking out money that puts you into a higher rate tax position, and that creates quite large tax bills because they're much higher. So for the dividend tax, which is a personal tax on dividends, as a basic rate taxpayer it's 7.5%, but as a higher rate taxpayer it's 32.5%. So that's not just double, that's way higher, and it can easily catch you out, particularly because it's taxed under self-assessment, and therefore you've got the 18 months worth of tax to pay in the first year because you've got to make payments on account. So understanding that if you take more than £4,000 a month out of your company, that's both salary and dividends, then you're likely to have a high rate taxpayer. Likely to have high rate tax to pay is an important way of making sure that you don't get surprise tax bills. So what do you do about it? I think the most important thing is to know your numbers. So I've talked about all of the theme going through all of this is about knowing your numbers, knowing where you are. Having your stuff up to date, so bringing your stuff in shortly after your year end is a really helpful way, because then at least you've got maybe 9 months or 8 months to save up. So a tax bill in 8 months' time is much less of a surprise than in 8 days' time. But also just knowing where you are so that you can perhaps make pension payments just before your year end, so you can then they're effective for reducing your tax in that year. Or maybe thinking about incorporating, because a lot of the high rate tax can be avoided by incorporating perhaps, and also the payments on account that you have in self-assessment can be avoided by incorporating. So incorporating can be an important way in making sure that your tax bills are more smooth and manageable. Thank you for watching. If you'd like more content like this, please consider subscribing to the channel, and it really helps me if you like the video. Thank you.